Hey traders, Jeff coming to you here, coming into the week of the 15th of December 2024. I want to take a few minutes to kind of review a little bit about this past week, this past month, and what we are anticipating moving forward into the balance of December here. So stay with me as we kind of work through this little scenario here. So weekly market recap, trends, insights, key setups, current market conditions, we're going to analyze how the upcoming Fed meeting on Wednesday, the FOMC meeting, is the macroeconomic indicators are shaping up the sentiment and volatility centered around that. What to consider for December 16th week, key events like economic data, year and market review, and so forth, developing hedging and uncertainty. And you're going to see in a few minutes here, as we begin to move higher in the market still, you're going to see that technology specifically, not necessarily the SPY, is beginning to break through, but it's doing it on light volumes. We're going to talk about that a little bit and what that could mean from a benefit, or at least maybe how you should position yourself for that. And you can use the VIX and safeguard with puts, spreads, credit sideways market opportunities, or maybe look at the VXX as an opportunity as well. The last 30 days of wins and losses, we'll share with that kind of how we're doing in this market. I think it's always important to know that how we're kind of transparent. We're finding ourselves getting in, and then we're kind of sitting back and waiting based on how the market kind of reacts. And then we're kind of waiting for the next opportunity. So we're not like, onesies and twosies here and there. We're kind of getting in 3-4 trades. We're sitting back, managing those trades, waiting for the next opportunity. We'll kind of show you that. And finally, live trading with full throttle traders and myself specifically, and how our real-time sessions focus on education, which empower clients to make informed decisions. So bear with me as we'll kind of work through this information here. First off, the SPY failing to make new highs. Why is that important? Well, the SPY is, a good amount of technology, a good amount of the broader market. Obviously, the SPY is going to move it up here. And although it was higher than the NASDAQ at one point, the NASDAQ has made a clear run back to the top here. We're going to take a look at that. I like to look at these in a couple different time frames. The daily chart, this kind of gives us that macro view. Drill down a little bit to the 65-minute chart, gives us a little bit more of what's happening inside those candles to kind of help us kind of just visualize a little more detail on the hour-to-hour basis in there. So you can see here just the trend lines going back here to October. I didn't kind of bring in the yen carry trade, the yen carry trade there, but just after that point in time, you can see how the indicators here are just basically flat, straight up and back here, right? So you got this trend line at the top, trend line at the bottom. They're equal in order. There's no really digressing to that top. So a lot of times you'll see in this type of market like volume, and you'll see this actually happening on the XLK and maybe the Qs. We're starting to see the indicators kind of go like this. Then you're starting to see the top create this little bit of an upward wedge. Now, typically, you might think a wedge is a breakout, and that could happen here coming into the Santa Claus rally. But at the same time is when you're after being overbought in an on-light volume, it's actually a bearish event. But you've got other indicators that could kind of make you be paused in that, like the 8 EMA. We'll look at that in the 21 and so forth. I like these indicators because they're reactionary. A lot of traders, a lot of market analysis uses this. A lot of algorithms built around these, at least currently. So again, the SPY data you can see failing to make new highs, and that's important for the things I mentioned. Let's take a look at the SPY 65-minute chart. Now, this is the same lines we're using on the 60-minute chart as you begin to see in here. You see the difference, how you're seeing this tape here, double topping in here, starting to get in the smaller time frames, a crossover here on the 8-period moving average against the 21-period moving average. So a lot of times you're going to be able to see that return on these smaller time frames. The smaller the time frames, the more often you're going to see them, but the more you're actually going to get kind of knee-jerk into those situations. So we're going to be careful that you don't do that and use the broader market to kind of adjust that. I apologize, I have some noise going in the background here, but we'll work through that. Anyway, take a look here at the XLK 65-minute chart. Once again, this is where we're starting to kind of see this little bit of a wedge come in here. In a sense, about 28% of the XLK is made up in the broader market. And so we want to keep that in mind here. We're seeing the semiconductors cooling back a little bit. NVIDIA's, your XMCI, a lot of news related around those stocks have been flourishing here. But the XLK has been kind of just digressing here inside these channels that we just saw here on the SPY. You look at the Qs daily, though, see how we're kind of wedging down. We have the upper line kind of like this and the wedge. Notice how we're comfortably above that 8-period moving average with the 21 being here. Again, you remember on the SPY, and I'll go back to it in a second to kind of help you remember that. But this was more of just a straight up more parallel channel in here. Here you're starting to see the highs, the lower highs in here. Now we're breaking through the tops. Once again, take a look at the 65-minute chart. Far different, isn't it? The way that these are not going inside these bars about midway. They're actually, even on a digress trend line up here, you can see how we're at the top and just breaking through. And that's when the last couple of weeks, the SPY was the Qs specifically tech has been to move way up very, very fast. So a little concerned. Let's go back to the SPY 1 second. You can kind of see here where we are pretty much, for the most part, almost sort of kind of engaging with the 8-period moving average here, for most of the week. Until that time, you did have your spots of pull down, push back in the markets here. People thought this was the end. Once again, making those decisions too quickly, you're going to be able to, it's going to turn back, and you see it 1, 2, 3 days back up here, and it was right back up at the top. So you'll be careful not to think that you're going to catch that turn in this bullish market in here. Typically, most all of your mutual funds, most large trading facilities are all long in the market in here, finding it more difficult to see a long market turn south. It's much easier to see one bounce off the bottom a lot of times, but typically they're even not necessarily going to make that move back up. Every time you think it does, pulls back again. So when you start to hit these tops and bottoms in here, they take time. You're going to have usually many fakes like this breaking down below the 8 and then retracing back up in here. One day you'll be right. They just actually will start that bear market. They pull back down into here. But to find that out, you're not going to have to wait for the breaks. Be patient, sit back, and see if you get continued breaks below the 21 and then maybe below the base. If they don't do this, right? And then if they do, you can look at the 65-minute chart to take the pullback back down. But if they don't, it's better off not to be short and just an early head fake in the market. That's where a lot of novice traders come in. They start reacting too quickly to the situation, thinking this is the end. And it's just not that way. It takes a long time to turn all that money that's been going bullish in the market for the last few years to be able to get that turn to happen in here. And usually it comes with a number of head fakes in here, and they're usually trying to manage their positions and get out of them versus kind of making money of the opportunity. So go back here to the XLK, Qs on the daily chart, Qs on the 65, we saw that. Once again, also take a look at the TXN. This is basically the 10-year yield. This is based on a 10th. So you're looking at Treasury yield at 4.25 for 4.339. Look how the Treasury yield has come back up. Now, this is fairly normal as we go into an FOMC clause. So with Jay Powell speaking here, although we are, mostly assured there's going to be a rate cut, anything's possible, but mostly assured that a rate cut is coming. It's more about the tonality that comes at the briefing of that, what the outlook is, at least from the Fed's perspective in here, whether it be right or wrong or something you stick to, the fact is the market react to that. So typically markets go back up with uncertainty and with high yields in the Treasury in here. Obviously, the market has been struggling in the broader market to kind of make those new highs. Technology is definitely a standalone. We're seeing it kind of go over. So we're at 4.39 in the Treasury yields here. We'll see how that comes in here. I suspect by Wednesday we'll be around 45. So rates are, definitely kind of creeping back up in here, but I don't expect them to stay unless something kind of weird happens here on FOMC, which is always possible. Let's take a look here at the last 30 days of trade. I'd like to kind of show this, what we do here. Again, we keep our risk pretty small, at least from a chart perspective. Now, all of our traders trade different size of risk and whatever they're comfortable doing. I trade a little bit more size, but this is all based on just a minor $250 risk. So I keep it the same. That way it allows some of our traders that maybe don't have larger accounts to do this. And we do a lot of diagonal spreads. We do a lot of, you can do bull call spreads and things like that. What that does is reduce the cost basis to allow you to get into a contract. So if you run a call spread for $6 and they cost you $6, right? And some people aren't in a position where it's going 10, 15, 20% of their account size. But if you throw a spread up against that on a diagonal, so to speak, with $4, you have a $2 net basis now. So someone that could not do that spread on the $6 can do that on a diagonal, or even more lesser would be that we get a better value doing a bull call spread, but you lose the significance of the decay on the short leg. So we talk about that in our training sessions, whatnot, each day, or actually Tuesdays and Thursdays. We have an hour-long session from Q&A to questions, talk about charting diagonals. We do teachings on that and trainings as well. So you can certainly learn a lot more about that. For instance, a lot of advanced traders typically like diagonals for a couple of reasons. Number one, they provide an insurance policy. They're typically trading a little bit heavier. Number two, they also give you a lot more creativity in how you can handle that. So you're not just dealing with a negative theta if it comes back against you on a long call. You're actually making money back on the short leg, either covering that short leg, or maybe you're adding some puts by hedging your position. This is something that we're going to be talking about here in the next couple of weeks in our chat room, is how can we hedge in a market that looks like it's going up on light volume into that wedge. It's getting to the point we could break through. Now, again, it's not any sign of that just yet, but it certainly is heading in that direction. We're in that Christmas rush. So I think a lot of investors with this far up have really pulled back, sitting on got a cash in here. Light volume has been kind of the modus operandum here as we're moving forward, because they just don't want to upset the apple cart till we get into 2025. So they're going to take the cash, trim some of those positions up there, and that makes sense. I would do exactly the same thing at that level of trading. So you can kind of get an idea of what our win losses in here. Again, I don't have our dashboard, but from time to time, I'll show you our dashboard. We're up about 170% since April 15th or so. And that's just trading a nominal risk here of about 2.5%. So 3-4%, we could do a lot more, even a lot more. The deal is that if you can be effective by looking at the broader perspective in multiple time frames, you can trade less, be non-emotional, and make more than if you traded more and become very emotional to take quick profits, or maybe have something go against you. A lot of times, less is more in the markets, especially if you're new. Once you get a little more advanced, have some seasons behind you, then you can obviously trade heavy risk with the same emotional outcome as you did if you trade light risk. And I think that's just experience and kind of seeing how the market kind of twists and turns. We can kind of get an idea of the style of trades that we trade here. A lot of vertical spreads in here. Short term, some of these trades were in 6 minutes for. And some of these were in 6 days for or longer. We do sell some puts from time to time, as we did on X back in here, do the ORB plays, open range breakouts, but there's a specific pattern and process. It's very specific. There's not like just what's a 15-minute breakout. That won't work long term. I mean, you're gonna, it's flipping a coin. But if you have some of the mechanics that we use, that Mayak talks about in his trainings on our Tuesday, Thursday mentorship calls, we dig into that and we go and look at that. What makes that orb an actual orb? Because it's not as easy as taking a 15-minute breakout. You're going to win some, you're going to lose some, right? But if you have a little bit more mechanics built into that, like what makes an orb work, and more specifically, what makes him be at that 80 percentile range instead of that 51% or 50% percentile range. And that just comes into detail of learning when a breakout is effective and when one might want to sit back or maybe even take a second breakout instead of the first. Weekly plays we do quite well. These are trading for income, where we get credits on a lot of these weekly threads, of course, the orbs as well. Verticals, we have a special thing called 18th candle. So far, the results have been pretty phenomenal in that. Very few, if any, losses in the 18th candle play. End of day flies, we do this where you have a credit spread. You don't find this very often, but you have a credit spread where you can actually make, have a risk of $30 to $40 per contract, but have a reward of 4 to 5 times potentially more than that. Typically, credit spreads or whatever the credit is what you make. But this specific style on pullbacks into the end of the day, we have the opportunity to limit our risk, but also open up our game, much like you're doing a debit, but in the form of a credit. Even if it's with SPX, you're obviously settling cash. You don't even need to, you could set the trade and go to lunch or go play golf or just be away from your computer. It won't matter because it's cash and your max risk per trade. So we go over all that if you like that style of trades. We do a lot of different style of trades, hedging ourselves, swing in stocks. Weeklies, a lot of weeklies in here. Those are just going to be 2 days to 9-day credit spreads, either bear calls or bull puts, playing the short-term directional and theta decay. capturing some money into a sideways move or even a progression move that allows us to make money pretty fast there. So we do quite well in there. You just kind of get a general theme from a win to loss ratio in here. We do quite well overall, but probably about 70%, 71% for the year this year. Some of the losses are pretty small. Then you have some bigger losses. Here's $45.95, 221, right? Some of the winners are smaller here, just taking profits. So it's okay as a trader to have a sideways market. It's okay as a trader to take break-even trades. You may see break even, win, lose, break even, slightly lose, slightly win, break even, lose. That's just kind of a normal. You go through cycles and basically very cyclical in that way in the sense of the stretches that you have because of the market conditions. Last week, you noticed the market was very back and forth. So it was kind of more of if you were long and you didn't give it enough range, you probably would have got stopped out pretty early in there, particularly if you were on straight calls or puts, as the market seemed to reverse itself quite a bit. And finally, in here, we're kind of redoing some things here. We found out from some of our members that sometimes people don't have the whereabouts to trade day trading in the morning because of maybe other commitments in their life and the option swing traders. So we kind of broke this down a little bit for people where they have the option to come in just on the day trade package and work with us in here where they can trade with me live for about 2 hours every morning. Actually going through my charts, you're watching me move in and out of these trades, show you the kind of the fixation of how we're looking at certain candles and trades. Most of these are pullbacks. I certainly used to be a breakdown trader, and I still do them from time to time. But I'm going to say the lion's share of my trading, there's been a lot of head fakes in these breakouts. The lion's share of my trading has moved into pullbacks, and a lot of times they're going to be on more like liquidity stocks, like Metas and the Amazons and the Apples and things like that. But I'll look through all stocks in there. So we try to do 1 to 3 plays of those every morning where we can get in, get out, and potentially have a Sharpe ratio of 5 to 6, meaning that the average of losers and the winners are mixed, or I could lose 4 or 5 times and still be break even on the trade. And we have a system and a mechanics on how to do that. When I get in, I show my platform. I follow a very, very systemized routine because the trade's the trade. I wouldn't have got in if I didn't believe that it was going to go up or down. Now I just have to follow mechanics and a trail mechanic. So we go over all that detail. Anyway, we've got back. You have the option to go in both of these here individually or as a combo package here. You can do this, but I think we added something here at the beginning here, but I've added a few different outlines of this. And this is what I call the pit stop strategy session. One thing that a lot of traders fail to do is as you have to reset. It's almost like you're taking off an airplane from, I live near Phoenix, Arizona, and you're going to Hawaii. Well, 90% of the time you're off course. And the key is that through aviation, and if they keep that plane, they keep pushing that plane back on course. And so without the kind of the proper mentorship, if you will, someone actually facilitating that and keeping you back on course, I think a lot of people end up where they think they're not headed to, they're headed there. And then by the time they get here, they have to make a complete sweep of their trading to get back on course. So this 3-month, 3 pit stop strategy allows me to meet with you about 45 minutes or so, which is about $250 or so if you were to do that kind of one-on-one with me. So that's about $750 in value. I'm just kind of adding to that little package in there. So you get 3 of those per year with me to help making sure your trading is on course. We'll analyze, we'll kind of make notes of where you were before and what you're looking to accomplish and keeping that plane on course instead of getting too far out and coming back. And I think that trajectory, if you're not staying on course, it's too big of a swing, too big of a change. And you kind of forget where your head is when you're kind of going out this way here to kind of bring it all back. Just make those changes along the way. This pit stop strategy will help a lot of our traders, and that's called drop the hammer. So certainly check that out on our site if you like to. Looking ahead next week at the markets here, we got Monday. We've got some earnings slowing down a little bit in here. You got Christmas in here. I suspect we'll probably stay bullish into the holidays or sideways bullish, if you will. Things to watch out for, though, is FOMC on Wednesday, Jay Powell. Like I said, we all kind of know where it's going as far as rate cuts, at least what we're fairly certain of. There's no 100% certainty in the market, but what we're fairly certain of, we want to watch the commentary at 2:30 here, the discussion with Jay Powell, the tone that he sets within the market. I think the last time he said, hey, we're going to cut rates here, but there's no really big hurry. Those 5 little words, right? No real big hurry forwards, actually sent the market on about a $2.50 move lower. 4 words. So a lot of the tone of that. And a lot of times, if it's just like that, they'll work its way back up. But if you're in trades coming into that, it could affect your outcomes. If you're in those 10 to 14-day trades, it'll affect your outcome and possibly stop out. So we want to be mindful that that can happen this Wednesday. So if you're in something, maybe take some profits coming into there, just kind of hedging yourself. And if he is all systems go, then you can ride the other half up a lot further than you probably would have otherwise. The other thing to watch out for is FedEx is going to report, and this is going to be probably a pretty big number here, is that they've been kind of headstrong here, along with UPS losing that big on earnings last quarter. We're going interesting people really want centered around FedEx, will it be the shipping industry? Because I think that's the crux of where the economy is, in this sense, right? In the sense that things are shipping, products are moving, people are buying, purchasing, things like that. But the other thing to watch is the Bank of Japan rate is going to come on Thursday, because although this is, maybe not a huge mover to us specifically, but with a recent yen curry trade, it's going to be a lot of eyes focused on that Bank of Japan rate change here, and then Carnival and Winnebago on Friday. So good things to come. I hope you guys enjoy the presentation here. From time to time, I'll bring out some market trends. I'll look at specific stocks. We'll draw these same lines and look at that on a multiple time frame basis, and then look at the broader markets. Kind of give you a different mix of things to think about, and also, mainly use this as an education service for us. If you like what you see, click the subscribe link, join our things. You'll be notified of these right away when they come out here, so you can get on board and take a look at the fresh news that's coming up here and how we're going to be responding to that. So anyway, a lot more to come. I hope you guys enjoy a great weekend, and we'll see you back in the markets tonight. Until then, great trade, everyone.